Hello, this is Rick Leibowitz from the Columbia Gorge Community College Small Business Development Center, and I'm here to talk to you today about evaluating your financing needs. So some things we'll cover is your sources and uses of funds presentation, which is basically how you evaluate your financing needs. We're going to talk a little bit about the cost of capital and forecasting payments. And we also want to have a little discussion about saying no to bad funding deals and why it's important to think about that ahead of time. So the first thing is to talk about the uses of your funding. So pretty much this could be broken up into two components. One is the project. You're either starting a business or you're expanding your business. So the project cost would be acquiring real estate, doing leasehold or tenant improvements. Sometimes you'll see that referred to as TIs, purchasing furniture and fixtures, or purchasing operating equipment or plant equipment. The second component of uses of funds would be operations, funding operations, or working capital. And this would be things like accounts receivable, inventory, and operating expenses for a predetermined period of time. Please understand that you can't expect a financer to keep financing your operations. There's a certain point in time when they expect the cash from operations should be able to cover your cash needs. Typical sources of fundings would be loans, vendor credit, credit lines, credit cards, friends or family, outside investors, or owner equity. This is what's known as the capital landscape. And you see a little graphic here with top funding sources. This is from a national study. You definitely want to look at what's happening locally. And these things change dramatically over and over again. I also want to add, if you see on there, it's become really common to use like Kickstarters and GoFundMe campaigns like that, which is known as crowdfunding. That is not something we're going to be talking about. Basically, we're talking about funding like loans where there's an expectation that you're going to pay the money back, or investment where there's going to be a return on investment. These crowdfunding sources is more of a donation to your business, and that's not something we're going to discuss today. So it's most important that as you come up with evaluating your funding needs, you have a clear forecast of your income expenses. You understand your cash gap, which is basically the sum of cash gained or lost from accounts receivable, gained or lost from inventory, gained or lost from accounts payable. And I'm going to do a little demonstration with that in a second. And then you also need to think about your financing needs, your loan payments, and in some cases you need to think of what you need to live on. You might need to take a certain amount of money out of your business every month so you can pay for your living expenses, and that's something that you're going to want to put into your forecast. So at this time, I'm going to open up a little spreadsheet that I have to give an example of this. So this is for Rick's Bagel Store. For those of you who didn't know, I used to own bagel stores, and I create this business plan forecast where I'm going to do $30,000 of sales each month. I'm going to have $10,000 cost of goods, so that's for my ingredients, my flour, my sesame seeds, my cream cheese, the sodas in my soda case. That's going to cost me $10,000. And I'm going to have operating expenses of $12,000 a month. So that's for my staffing, my advertising, my insurance, and things like that. That does not include money for myself. And let me delete out these numbers that are in here, and we'll just start from scratch. Now, I started out with $10,000 in my checking account. So if I do $30,000 of sales, have $10,000 cost of goods, $12,000 of operating expenses, my profit and loss from operations would be $8,000. So in theory, I would go from $10,000 to $18,000 in cash balance because I've gained $8,000 from operations. But there are certain things that can happen that will prevent that from happening. So for example, let's pretend that all of my sales is to other stores. So I do wholesale accounts and I sell to all these supermarkets. And I sell $30,000 of bagels. And they say, hey, Rick, we're going to pay you next month for those bagels. I need to give them 30-day terms. That would be accounts receivable. So in the first month, even though I did $30,000 in sales, I didn't receive that $30,000. So I have to put in my provision for accounts receivable, which would be negative $30,000 here. And as you can see, that takes away my cash balance right there. I go into negative 12,000 of cash. Now the other thing is inventory. So if you look down here, here's my starting balances. I started out with $10,000 in inventory. Basically what I could do is say, you know, hey, instead of going out and buying $10,000 of ingredients, I'm going to deplete my inventory by 5,000 and only buy 5,000 of replacement ingredients. Well, if I did that, that would give me $5,000 of positive cash flow, because instead of me buying the ingredients, I used 5,000 of the existing ingredients that I already paid for in my startup. So now I'm down to negative $7,000 in cash there. Then what I could do is the same thing that my customers did to me. I could call up my flour company and say, hey, I have to wait 30 days to get paid from my customers. Can you wait 30 days to get paid? And they do a credit check on me. They find out I have really good credit. And they say, okay, you can go ahead and have $10,000 of accounts payable. So I gained $10,000 there. So this is my cash gap. I lost $15,000 of cash this particular month between accounts receivable, inventory, and accounts payable. So if I lost $15,000, how come I still have $3,000 cash balance negative? Well, it's because I gained I started out with $10,000 in the bank. So my total net cash flow was $7,000. I lost $15,000 in my cash gap, but I gained back $8,000 of that in being profit from my operation. So basically I have to wait for my profit. But as long as this number's in the green, I'm okay. So then if we look at next month and we make the assumption that from here on out, I'm not going to use from inventory anymore. I'm just going to buy what I need. I'm going to buy this $10,000 every month. Accounts receivable, while I've developed my pipeline, yes, I have to give $30,000 accounts receivable in February, but I'm going to collect $30,000 from January. So that's going to zero that out. And it's the same thing with accounts payable. I'm going to pay $10,000 from January, but I'm going to gain $10,000 from February by waiting to pay that until March. So from that point moving forward, again, you'll see I start going up $8,000 a month. But then my wife says, you know, hey, Rick, I can't bring in all the paychecks here. You know, you started this business, you used to make $5,000 a month. You need to bring home $5,000 a month. Well, that's where I'm going to put in this $5,000 right here. But you can see that I still stay in the green. But then let's look at, you know, when I started this business, I went out and I got financing. And let's say, I think I actually have it down here. Yeah, I had a $50,000 loan. And my banker says, you know, hey, you need to pay that $50,000 loan off over 50 months. And I'm just saying 50 months, so my math is easy. You take the 50,000, you divide it by 50 months, and that's $1,000 a month right there. Whoops, and we need to make that a negative $1,000 a month. But again, I'm still in the green here. Nothing to worry about so far. But then let's just say that in March, a piece of equipment breaks, Rick's bagel machine breaks, and I happen to know a bagel machine costs me $10,000. So I need to go out and get a new $10,000 bagel machine. Well, whoops, I'm in the red here. So what do? So in this particular month, I might go out and get a $10,000 loan. So if I get that $10,000 loan to pay for the bagel machine, it would be $10,000 positive minus the $1,000 payment I have to make on my other loan. So this becomes 9,000. I'm back to positive again. And then let's make the assumption that I have to pay that loan off at 1,000 a month. I'm going to pay that loan off in 10 months. It's a short-term loan. So then this would go down to 2,000 here. This would go down to 2,000 here. And this would go down to 2,000 here. Whoops. And by June of 2017, even though we're in 2018 right now, I would still have positive cash flow. This is what you need to do with your particular business. You really need to think about how things are going to impact the cash of your company. You know, in some cases you might have credit card payments, you know, but in most cases, we're really looking at the main three being the accounts receivable, inventory, and accounts payable, and the loan payments and the owner's draw also being important to your business. That's how you evaluate the sources of your funding. Let's go back to our presentation. So the other thing to think about is the cost of capital. And one of the things I did not put in, so I just put the loan payments in there. I did not break it out, how much is interest, how much is principal on the loan. So you do want to think about what interest rate they're charging. I'm going to give you a very quick caution here. The easiest money to get tends to come at a very high cost. There's a lot of quick loans out there, and they're not necessarily the most honest people in the world, and they'll say this is a 10% interest rate, but what they mean is 10% a month. I have actually watched clients sign deals where they're paying back money at over 100% interest. So that means, think about that. You borrow $5,000, within a year you have to pay back $10,000. There's a lot of credit card loan payments where they take a certain amount out every day, and they'll say, oh, you just have to pay 10%. But that means you need to pay back 10% a month over 30 days, and they divide that out daily, and then they charge a service charge on that. And it's because it's not called interest, they can get away with doing that. But if you compute out what you're paying, it's the equivalent of taking out in some cases, 50 to 100% interest. So please do not sign a financing deal with having a clear analysis of what you're paying back. Other cost of capital is your investor returns. Sometimes you're required to pay back, if you have an equity investor, they'll say they want a return of equity over a certain period of time. Or sometimes they'll have guaranteed dividends that you're required to make for your business. So you need to think of those costs. For LLCs, it's very common. This is especially with service companies where someone becomes a partner of an accounting firm, a law firm, or a medical practice, and they'll require a certain amount of payments per month. Well, the business might be profitable, but there might not be enough cash to make those payments. And the big example of that would be a doctor's office, where you go out and you do $100,000 of billing this month, but the insurance company is going to take you 3 months to reimburse you for those billings. So that physician might require $10,000 a month in guaranteed payments, but you haven't received the money from the insurance company. So you need to make sure that you're thinking about these things, using a very similar cash flow statement to what I showed you previously. And then the other thing is the owner burden. What do you need to take? And again, think about your opportunity cost. What were you making when you were working for someone else? Make sure that you're making the same amount. So as you negotiate terms for your financing, pay attention to the interest rate, the years to repay. In some cases, there might be covenants where they are gonna, you can only get financing if you show that you have a certain amount of accounts receivable or you have a certain amount of inventory on hand. They might not extend your credit line if you don't maintain those things. In some cases, you have to put up collateral. And then one of the other things, if you're getting private money, is what percent ownership are you willing to give up? These are all things that are negotiable. It's a very good idea to first and foremost talk to your small business development center counselor and get some advice, but then also review that with an attorney and in some cases an accountant. And finally, we like to tell you, be prepared to walk away from a bad deal. One, consider the time value of money. Money today, if it comes at too high of a price, it's just not worth it. If someone wants 30% interest, think about what you can do to put off the deal in some cases and make more money, make some money now and invest it yourself, where you're going to do better and have more of a down payment. So the money you get in the future, it's not costing you as much to run your business in the future. I've certainly been in situations where I had a very successful bagel store. It was profitable, but I had to pay back my loan in 3 years, where I really needed a 7-year loan to make that business work. And it just put a lot of stress on me. Think about the cost of default. Can you handle walking away from the business? This is especially if you're working with some bank financing. And then again, I use the term opportunity cost. When you look at a deal, you should be forecasting how much money you can make a month from the business. Are you giving up too much? Are you walking away from a job where you were making $5,000 a month to go ahead and make $2,000 a month and have a lot more stress on you with the responsibilities of owning a business? So these are all things you need to think about. And in some cases, the only thing that keeps you from making that $5,000 a month right away is the cost of financing. It's just the wrong financing deal for you. So go out and find a better financing deal. So remember, create very solid startup and operating budgets, make researched assumptions, use tools to save time. I just showed you a very simple cash flow tool. Work with your business advisor and plan these things out ahead of time. And just a reminder, you can find us at bizcenter.org, or you could talk to our Capital Access Team program members at bizcentercat.org. Look forward to working with you on the next project. Thank you.